Hello, good morning. It's Friday the 24th. I'm FX Blue and this is the market brief. So there is a growing edginess to the economic outlook in the UK at the moment. We had the data from manufacturing and the service sectors yesterday. Manufacturing output fell slightly while services posted a slight increase, leaving both sectors well above the line for the time being. But this is expected to change going forwards. After Sunak's spring statement, growth forecasts for 2022 have dropped to 2.2%. And with rising inflation at the fastest since 1992, that could peak at 9 or 10%. That all means that the standard of living is expected to fall to the lowest level since 1955. 1955! That's bleak. They didn't even have colour TV back then, and correct me if I'm wrong, many were going out to their garden outhouse for a good old number 2. Imagine that in the middle of winter. Like I said, bleak. So, against the backdrop of crapping in the garden again, the government has a pretty tough summer ahead. Credibility of leadership has still not recovered from Partygate, because those Downing Street turkeys were certainly not all popping out for a number 2 at number 10, that's for sure. But away from the UK, Russia may have made the first move in the energy war with the West. They've demanded that gas sales to unfriendly nations should be paid in rubles. First of all, with all the Russian money that has been laundered through London over the years, surely the UK retains a little friendly status. But more seriously, this does suggest that the war has perhaps lasted a little longer and is costing a little more than Moscow was originally prepared for. With their exclusion from the world markets, this is a route for Russia to collect some useful domestic currency revenues. Whether or not it'll have much effect, we'll have to see. In the market, sterling lost a little ground yesterday. We dropped to 131.55 against the dollar, and we open around the euro against the euro around 119.85. Over in the US, several Fed members have been on speaking of the need to step up the tightening of monetary policy in order to fight US inflation. Where previously the reduction of the Fed's balance sheet was seen as of secondary importance to raising interest rates, the two may now go hand in hand. This means that at the next Fed meeting we may see a 50 basis point rate hike, while they also begin to sell off some of the assets previously purchased when supporting the economy through COVID. Inflation looks likely to remain way over target this year, so there are grounds for a more aggressive move next month to help catch up the inflationary curve. To put that another way, one Fed member has forecast the need for 7 further rate hikes this year, with only a small risk that those hikes could be overdone. 7 rate hikes and only a small risk of overshooting? With those forecasts knocking around, there certainly seems to be enough inflationary slack to stomach a 50 basis point hike next month. Keep an eye on that one for sure. Weekly jobless claims came out of the US at 187,000 new claims, which is the lowest level since 1969. That comes as the dollar index has recovered a degree of strength over the past couple of days. Yesterday we reached 98.95. The 99 level still appears to be attracting sellers for the moment, but if the momentum continues, we'll surely break through that soon enough. And then euro dollar, that's been trading between about 109.80 and 110.25, and we opened this morning to the upper end of that range. That's it from me this morning. Have a great weekend, and do join me again on Monday. All the best.
If you do not have a clue, then just tweet through and ask FX Blue.